Hey guys, welcome to the Trade Genius Podcast. Bob and Phil here. As always, guys, the Fed has screwed up. They're going to plunge us into a major recession. Don't believe us? Watch.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Hey Bob, so bulls gained some ground today. Market perking back up. Looks like we might get that oversold bounce we've been telling the folks about. However, in the macro, things are looking, well, let's just say it doesn't look so hot going forward through 2024. And surprisingly, I think what most people don't realize, most of 2025 actually could be underwater as well. What do you think?
Yeah, I mean, the Fed performs brain surgery with a mallet. It's just amazing to me. I'm going to show you guys a couple charts. It's funny because, you and I were talking before we, our show prep, and we're just saying the Fed just doesn't know how to moderate. It's just like,
right.
It's like they're bipolar. And I don't know what it is. They're so afraid that they can't see the reaction before the reaction, kind of a thing. But this chart here blew me away, is that they did it. They basically are contracting credit. Now everybody says, hey, congratulations, Fed, you did a great job on this. But it is with rates so high that this thing is going to be a plunge-o-matic. And this 2008 credit contraction, this thing's going to blow through it by the time it's all done, because there's going to be nobody that's going to want to take out a loan by the time this thing's over, Phil.
Right.
And this next chart will kind of tie into your charts then too, is that we create this environment called a bear steepener. This is when the rates on the longer end of the curve, which means the loans that are farther out in time, like the 10-year, the 20-year, the 30-year, are rising faster than the shorter duration loans. And when that happens, it's always a kiss of death, and it's always a recession. And so you have some really cool charts, but I want to throw this back to you for some comments before you show your charts that kind of tie into this.
Right. As far as like the credit contraction, I think that part of this is going per plan for the Fed. I think the problem that we are going to get into, and that kind of segues into what we're going to talk about in these next two charts. First, I want to talk about how that relates to the Fed raising rates. Rates are a big headline in the markets right now. Interest rates are going way up on the yields of the bonds and the T-bills and things like that. Money market fund rates are going higher, but I think that party's coming to an end. And the reason for that, and this is a graph that we've shown in the past for some of you newer subscribers, this is what we are looking for to happen for them to not only pause indefinitely, but probably start looking at cutting rates. This is a chart. In blue, you have the Fed funds rate. So you can see prior to every recession, you get a ramp up. You get a pause with a flat top, and then you start cutting rates into recession. What's been wild about this cycle is that the yellow line is under the red line. The yellow line is our unemployment rate. So normally what the Fed wants is an unemployment rate that is higher than the core PCE rate. The core PCE is in red. As you can see, historically, this is highly unusual that we have unemployment rate below the core PCE rate. That means inflation is running hot and they want to cool down the job market. So as they create the credit contraction, they make it harder for this economy to borrow cheap money. If you borrow cheap money, you're leveraging that, you're getting expansion in the economy. It's gone on too long and it's created a lot of inflation problems for the Fed, and it gets out of hand, right? And it creates a larger crash down the line. So you got to take the medicine now. So we're almost to the point now where the unemployment rate is going to go back over the core PCE, which is historically what should happen. And this is what the Fed's been intending to do. So this part of the plan has been working out, and they are going to get it, and unemployment rates are going to keep going up. However, we're getting the effects of the interest rates are climbing up high, right? And you've been hearing people freak out about the bond market. Well, it's just like in 2020, Bob, when they hit the printing presses hard and they overshot and they gave us inflation. And they've done the same thing with the interest rates. They probably should have paused earlier, even though on the surface it seems like they should have raised. But in this environment, the bond market and all that stuff, it's creating now they're going to possibly overshoot, because I don't think yields are done. I think we're going to take a break on yields and they're going to pull back, but I don't think yields are done. And I think, even Jamie Dimon threw out 7%. And I think Rick Santelli threw out like 13%. I think 13 is a little high, but we could certainly see higher rates. And so I think the Fed knows that. I think that we have that lag effect, right? Because they always say raising Fed fund rates has a major lag of about 12 plus months in the economy. And I think you're seeing that. And I think you run the risk of these yields going too high, which is going to be bearish. So I think they're done. I think that we've gotten that. We're going to get this catalyst here where yellow crosses up over red, unemployment comes up, and this is going to pause. And that's going to play right into the yield curve. That's the next chart, Bob. We have our yield curve, 210 yield curve. Now you guys can see it's been extremely inverted, blowing out the last two recessions in terms of how inverted it was. And what does that mean? That means that when you bottom, you can expect 100 to 120 weeks of a bear market. Why? Well, because we're going into a recession and your bonds tend to be the flight to safety. And why? Because they're the easy money return. You don't have to do anything. Stock market's in decline. Meanwhile, your bonds are gaining 4 to 5%. And on top of that, they typically will rise in value, the face value of the bond. So you got a double whammy to the upside, and you're avoiding the disaster of the stock market until this all plays out. So what does that mean? Well, we overlaid this red chart on, it's kind of like a projection of candles based on these last two recessions. And you can see we're starting to roll over. I know it's a little hard to see, but we're rolling right over with this. And that means if this plays out similar to the last two recessions, and I think it will, because structurally things look very similar in terms of the yield curve inversion and all that stuff, we won't come out of this till October 2025. And the reason why I find that plausible, Bob, nobody's talking about that. They're talking about, mild recession, dip in 2024, Bitcoin's going to bottom in the halving and take off. How about no major lag, major L-shaped recovery, and then we really don't start taking off until Q4 of 2025? How about them apples?
Yeah, I mean, they have worms in them. So it's amazing. People don't really realize what's happening. We showed that chart yesterday when the bond yield and the stock yield touched.
Mm-hmm.
I mean, that doesn't happen. Right. When that happens, every risk manager in the world is going over talking to their asset manager and saying, hey, you got to get in the bonds now.
Right.
And I think we're going to get our relief rally. As you pointed out, typically these are 200 to 300 point moves. It seems implausible, but how many times have we tried to short a rally that shouldn't be there, right, Phil? So right. You got to kind of let the air decompress and let this thing pop, and then I think nature will take its course again. The only interesting thing about that going forward is that, and I'm not smart enough to know because I can't see the data. They keep that stuff all behind black boxes, but I'm told that we get a pop, we get a drop, and then we get a Santa rally into January. That could be pretty bold, and that kills the market. So I have to be in the back of my mind open to that, because the people who suggest that aren't CNBC type people. They're actually reading actual data. So I'm kind of keeping that open, and that kind of seasonality a little bit too. But I'm definitely open to the possibility that this thing has played itself out, and we're looking at some last hurrahs. So I'm looking at like my long-term portfolio, which is not geared towards the memes of the day. And a lot of these stocks that we own never even came up in the April rally. Stocks that we want to own that there's grind away. I sell calls against them. It's no big deal. But, there was no pops. Right. Only thing that popped were the high cap stocks, Phil. And I think, too, this is the third year in a row where small caps underperform large caps. So if the large caps start underperforming, I don't think people are going to roll into small caps. I think they're just going to roll right over to the bond market, don't you think?
Yeah, I agree. I think that the upside to getting yields for the next couple of years at these rates are going to be too enticing. And I think they're going to continue to leg into the bond market. I still think the bond market has probably another potential flush to go. But by and large, And I know in the short term, we've seen some significant inflows institutionally. So I think by and large, we will see the bond market stabilize and go back higher. And I think you will see things like TLT go higher. I think TLT's got a hurdle at like $94 to get over. But once this recession goes into effect, guys, it's like it always has been. Bonds will go up, equities will go down. Right now, they're kind of tied to the hip, right? If bonds are bought, so are the equities. But that will diverge. And I think that's going to diverge over the next couple of quarters. So that's really going to be the confirmation. The other confirmation too you have on this yield curve chart is when you start to go to parity on the yield curve, which we're almost there, we're getting there at 0%, that usually tells you that the top is in. So once we hit that, I think top is definitely in, and then we're going to start rolling over harder, and then we'll start looking for that divergence. The other thing I'll show you guys, Bob's point about the bounce that we could potentially get here. There's a bunch of lines on this chart, but essentially we've come down to the weekly 50 SMA. This is a big level, guys, all right? This is not a level that you sneeze at. And the reason for that is it's typically the level that you initially are going to bounce off of. Now, I'm overlaying it on a 4-hour chart, but here's the last time we were trending, and then we fell down to it, chop, 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 and then boom, we went right up to the weekly 9 EMA. So the setup is very similar. And because these are large moving averages, you get very consistent reactions to them. It's not like we're trading a 1-minute chart here. So, I think if we start busting over the daily 9 in that blue, I think we potentially can run up to the weekly 9 up here, which would mean that we would see, that 200 to 300 point move that we think we can get off of this. So that's why Bob's saying, it's a bearish setup overall in the market. But we can't ignore the fact that we may just have a squeeze here for 200 to 300 points. And it can happen really quickly. I mean, if you guys watch how this market moves, I mean, these moves are violent, right? These moves that go for 2 days, 3 days, they can be really violent, like here, just violent move, right? And then it collapses. And people are wondering, oh, gee, what happened? Well, it's because you're not looking at it structurally and knowing that you got big support here and big resistance here and it's compressing. So I'm with Bob. We got short-term bullishness, but make no mistake, the recession, I think, is probably here. And I think it's going to be longer and deeper than most people want to accept. And they really won't realize it. And CNBC won't be talking about it until we're about 6 months into it. And it's too late then. You should have hedged way higher. So that's primarily what we've been warning about over the last couple of months, actually the last 6 months. And hopefully, you guys will be able to take advantage of that. And because if you can buy lower in this market, that's how you, over the lifetime of your portfolio, will outperform this market by multiples. You get out, you hedge up here. Imagine getting back in the market at 3,000. I mean, the market will never outperform you if you're a buy and hold from that level.
Yeah, and if you're a Republican, a recession all the way through to the end of 2025 doesn't mean good news for the party in power. So it should be a pretty interesting year next year, but I think it's going to be bumpy road. This is like a plane coming down and making a hard landing, Phil.
Yeah.
It bounces and then it pancakes onto the runway.
It blows out those wheels. I agree. All right, guys, well, let us know your thoughts. Do you think we're crazy or do you think we're on spot with this analysis? Love to hear your thoughts on this and what you're doing. And how's things looking in your neck of the woods? How's the economy doing? Let us know your thoughts below. Otherwise, guys, check out our stuff over at tradegenius.co. Get in the room with me and Bob. We navigate these markets day in, day out, week in, week out, and we'd love to help you. Otherwise, we'll see you on the next video. Take care.
Trade Genius.